In 2016, Paul and Cynthia Martin of Indiana received a notice of deficiency from the IRS. The Martins decided to petition the notices and left it to the tax court to decide their fate. That decision would end up to their detriment, costing them over $100,000 in tax deductions, spanning over 3 years. This is a story of why you save your receipts and hire a tax professional. Taxpayers Paul and Cynthia Martin, a married couple from Indiana, are petitioning against the United States IRS Commissioner to deduct all of the tax losses their rental properties generated in 2012, 2013, and 2014. Paul worked as a full-time salesman, while his wife Cynthia was a part-time office manager for a construction company. In an effort to expand their financial situation, Paul and Cynthia also had investments in 3 residential properties in a neighboring state. For 3 different tax returns, Paul and Cynthia reported huge losses from their rental properties, along with large amounts of itemized deductions under the guise of unreimbursed employee expenses and job search costs. In 2016, the IRS Commissioner issued a notice of deficiency for all 3 years. An IRS notice of deficiency is a legal notice in which the IRS Commissioner determines the taxpayer's tax deficiency. Tax law requires that the IRS issue a notice of deficiency before assessing additional income tax unless the taxpayer agrees to the additional assessment. Paul and Cynthia now bear the burden of proving that the Commissioner is wrong. The Commissioner disallowed the Martins' various rental tax deductions, reducing their net real estate losses, and recategorized the remaining losses as passive losses. Not only that, but the Commissioner disallowed all of Paul and Cynthia's unreimbursed employee expenses and job search costs for tax years 2012 through 2014. After receiving the notice of deficiencies, the Martins quickly filed petitions to the tax court. The Martins believed that they were in the right and they should be able to take the deductions that the Commissioner wanted to disallow. Paul and Cynthia had to actually prove that they were entitled to those deductions. There's a mountain that they had to climb called Internal Revenue Code Section 6001. Section 6001 requires that taxpayers maintain records in a manner that establishes the amount of each deduction claimed, also known as saving your receipts. There is some leeway though for proving tax deductions thanks to what's called the Cohen Rule from the court case Cohen v. Commissioner. The Cohen Rule allows the court to make an estimate of what is allowed to be deducted if the taxpayer cannot substantiate every dollar of the deduction. The taxpayer still needs to provide credible evidence of the deduction for the estimate to be made. We'll soon find out if Paul and Cynthia are able to prove their deductions are legit or not. Let's first discuss the rental deductions that the Commissioner disallowed. The Commissioner disallowed $81,619 worth of auto and travel expenses claimed over the course of 3 years. Auto and travel expenses are subject to strict substantiation requirements of Section 274D. Section 274D overrides the Cohen Rule that we just talked about and requires strict substantiation specifically for travel, meals, and certain listed property. Why is that? Because these deductions are notorious for being taken advantage of by fraudulent taxpayers. How are Paul and Cynthia supposed to substantiate these expenses then? They must present sufficient evidence or adequate records to corroborate their deductions against the amount of the expense, the time and place the expense was incurred, and the business purpose of the expense. So in order to substantiate auto and travel expenses through adequate records, the taxpayer is required to maintain a logbook with relevant information prepared contemporaneously with use or expenditure and documentary evidence. The tax court opinion states that a log that is kept on a weekly basis is considered contemporaneous for this purpose. Paul and Cynthia thought that they could get away with a mileage log that appeared to be made well after the fact. The Martins submitted their mileage logs to the tax court. However, they were missing the dates of travel or the places they traveled to for tax years 2012 and 2013. For 2014, the log didn't even list the places Paul and Cynthia traveled to. Mileage deduction denied. To substantiate travel expenses, we're not talking about the vehicle mileage anymore, by the way. The Martins submitted receipts and credit card statements that provided no context as to why they should be a rental deduction. Not only that, but there was a trip to Puerto Rico that they were trying to deduct. Seriously, guys? Puerto Rico? This sounds like the Martins were trying to implement the bad tax advice you hear on TikTok, but TikTok didn't even exist at this point in time. Travel deduction denied. The commissioner disallowed $5,206 for the utilities deduction on the Martins' 2014 tax return. The Martins argued that they were required to pay their tenants' utilities, but they were unable to provide evidence of actually making the payments. Utilities deduction denied. The commissioner disallowed $5,110 in management fees that were deducted across 2012 through 2014 tax returns. The only evidence to substantiate the deductions were handwritten receipts that were most likely written by Cynthia. Management fees deduction denied. Pro tip, if you're going to try to deduct expenses, make sure you keep the actual receipt or a copy of it. In 2012 and 2013, the Martins' son lived in one of their rental properties. $16,103 worth of rental deductions were claimed for this, quote, rental property. This is where section 280 Cap A comes into play. 280 Cap A disallows deductions with respect to a dwelling unit used as a taxpayer's residence. Even though the Martins' son rented from them, it doesn't mean they're actually allowed to take tax deductions related to the rental he's living in. Section 280 Cap A D states that a taxpayer is considered to have a dwelling unit as a residence for personal purposes for a number of days which exceeds the greater of 14 days or 10% of the number of days during which the property is rented at fair rent. A taxpayer is deemed to have used a dwelling unit for personal purposes if, at any point during the day, the taxpayer's family member uses the rental property for personal purposes. You can avoid this if the family member is renting the residence at fair market value. The Martins could not provide any evidence that their son was actually paying rent. Rental deduction denied. The hits just keep on coming for Paul and Cynthia's rental property deductions, but wait, there's more. The commissioner determined that the Martins' rental real estate losses were subject to passive activity restrictions of Section 469. When a taxpayer has passive losses, the only way to deduct those losses is by having passive income to offset the passive losses. Passive activities include, but are not limited to, trade or business activities in which you don't materially participate, like rental properties, being a limited partner in a partnership, or not being actively involved in a business. There is an exception for rental real estate activities. You can materially participate in rental real estate activities and still be subject to passive loss rules. That is, unless you are a real estate professional. If you are a real estate professional, the Section 469 disallowance does not apply, and you can deduct as much passive losses from rental real estate activities to your heart's desire. Now, the Martins owned multiple rental properties. They spent time to keep them maintained and rented out. We must be real estate professionals then, they thought. To qualify as a real estate professional under Section 469, you must own or partly own at least one rental property, and more than half of the personal services performed in trades or businesses by the taxpayer during the taxable year are performed in real property trades or businesses in which the taxpayer materially participates. And the taxpayer performs more than 750 hours of services during the taxable year in real property trades or businesses in which the taxpayer materially participates. Whew, man. For context, a real property trade or business includes development, construction, acquisition, conversion, rental, operation or management, or brokerage of real property. Let's break it down with a simple example. If you work a full-time job for an employer for, let's say, 2,000 hours, you must then have 2,001 additional hours working on your rental property or properties to qualify as a real estate professional. Here's another example. If you're a real estate agent and work for yourself, all of the time spent working on selling homes counts, but you still need at least 750 hours of slinging real estate. If you are married and one of your spouse meets the requirements as a real estate pro, then the other spouse does not need to meet the requirements. All right, back to Paul and Cynthia. The Martins provided time logs to support the hours required to be a real estate professional to the tax court. However, Paul or Cynthia could not provide testimony that their jobs had anything to do with real property trades or businesses. Not only that, but some of the logs were unclear as to whether they were Paul or Cynthia's. So it sounds like they didn't document anything. Real estate professional status denied, and all losses reclassified to passive. This means that any deductions that were allowed for Paul and Cynthia's rental properties, the losses would be subject to Section 469 limitations. But there is a relief provision under Section 469I that helps the Martins for once. Section 469I allows up to $25,000 in annual losses from rental real estate to be deducted by individuals who actively participated in the rental activity and has an adjusted gross revenue, aka AGI, under $150,000. For 2012, the Martins' AGI was under $150,000, but for 2013 and 2014 exceeded $150,000. Passive loss deduction granted and denied. The commissioner disallowed $46,307 worth of unreimbursed employee expenses across the Martins' 2012 through 2014 tax returns. Back before the Tax Cuts and Jobs Act of 2017, employees could deduct some of their unreimbursed employee expenses on their Schedule A, also known as itemizing deductions. This was part of the 2% floor deduction on job and miscellaneous expenses. The unreimbursed employee expenses must be qualifying expenses under Section 162 of the tax code and must be expenses paid or incurred as an employee. A taxpayer is only allowed to deduct unreimbursed employee business expenses under 162A to the extent that the taxpayer demonstrates they could not have been reimbursed by their employer. Section 162A allows a deduction for ordinary and necessary expenses that a taxpayer pays in connection with the operation of a trade or business. Tax pros love to whip out 162A when asked what is a business deduction. Keep in mind, as of 2022, unreimbursed employee expenses are not an itemized deduction and are not set to be back until 2026. Keeping with the trend, Paul and Cynthia were unable to substantiate the unreimbursed employee expenses. Surprise, surprise. This is where it gets a little questionable. For 2013 and 2014, Paul tried to deduct job search costs under the same Schedule A section as unreimbursed employee expenses. Evidence provided for the job search costs was a credit card statement showing the husband paid expenses in Swiss francs, and paid $600 for an upgrade for a US Airways flight. On the credit card statement was job search costs handwritten onto it. Sounds legit. Unreimbursed employee expenses and job search costs deduction denied. The Martins ended up having to pay $44,565 in tax due to their denied deductions by the commissioner and the tax court. On top of the tax, there were accuracy-related penalties for $8,913. This case isn't meant to make you afraid of the IRS, but instead empower you to not make the same mistakes Paul and Cynthia made. It is unclear whether the Martins were intentionally trying to defraud the IRS or if they were just terrible record keepers. I hope you enjoyed watching this video. I'd love to make more of these videos. These tax court videos are inspired by two other YouTube creators called Chubby Emu and Popomatic. Link to their profiles in the video description. Thank you for watching, and don't forget to save those receipts.